Ever been curious about how companies raise funds for their massive projects? Today, we're diving into the intriguing world of debentures. Essentially, debentures are financial instruments that companies use to raise capital. Picture them as loans, where the company becomes the borrower and you, the investor, play the lender. The company is obligated to pay back the principal amount along with interest. Intriguing, isn't it? Now you know what debentures are, but how do they differ? Let's find out. Debentures are not all created equal. They come in various types, each with unique features. Let's dive into the four main types. First up, we have secured debentures. These are backed by a specific asset or group of assets owned by the issuing company. Imagine it like this. If the company can't pay back the debenture, the assets are sold off to repay you, the investor. Next, we have unsecured debentures. These are not backed by any specific assets. It's a bit like lending money to a friend on a promise they'll pay you back. Then, there are convertible debentures. These are special because they can be converted into equity shares of the issuing company after a specific period. It's like a ticket that could potentially upgrade to a VIP pass. Lastly, non-convertible debentures. These are plain vanilla debentures. They can't be converted into shares, but typically offer higher interest rates as compensation. Understanding these types is crucial to grasping how debentures function. But how are they issued? Stay tuned. The process of issuing debentures is a meticulous one, governed by stringent rules and regulations. To kick things off, a company must comply with various regulatory requirements. This includes getting the issuance approved by the board of directors, and in some cases, the shareholders too. Next, the company will obtain a credit rating. You see, credit ratings are crucial as they signal the creditworthiness of the company to potential investors. Higher ratings often translate to lower interest rates on the debentures, making it cheaper for the company to borrow. Then, a debenture trustee is appointed. This trustee's role is to safeguard the interests of the debenture holders. They ensure that the company fulfills its obligations, such as making timely interest payments and repaying the principal amount. Thus, the issuance process is a balancing act, with multiple players and interests at stake, all working in harmony to ensure a successful debenture issuance. Now that we've navigated the issuance process, let's turn our attention to how debentures are priced and valued. Pricing and valuation of debentures are influenced by various factors, including interest rates, credit risk, and market conditions. When interest rates rise, the price of existing debentures falls. Why? Because new debentures will offer higher coupon rates, making the older ones less attractive. Conversely, when interest rates drop, the price of existing debentures increases. Credit risk, the risk of default by the issuer, also impacts the pricing. Higher the credit risk, lower the price, and vice versa. Market conditions, such as economic stability and investor sentiment, further sway the price and valuation. Now let's talk about risks. The two primary risks associated with debentures are credit risk and interest rate risk. However, investing in debentures can also yield potential rewards. They offer regular interest payments and, in case of convertible debentures, an opportunity to partake in the company's growth. Understanding the risks and rewards of debentures can help investors make informed decisions. We've covered a lot today, from understanding what debentures are, to their types, issuance process, pricing, valuation, and risks. We've dived into the nitty-gritty of corporate finance and made sense of the risk-return dynamics. Remember, knowledge is power, especially when it comes to investing. It's crucial to understand these concepts before you venture into the world of debentures. Now that you're a budding Mazuma master, why not subscribe for more insights into the world of finance? Until next time, keep exploring, keep